Today, George?
Well, I'm wearing my Maine hat today. My son went to the University of Maine, and I'm wearing my Maine hat today because this is kind of the hat I wear when I need to calm myself down.
That's your therapy hat?
Yeah, it's a therapy hat, yes. But I'm so proud of my son and what he accomplished. So I wear this hat because it always makes me feel better. And I'm having a morning where I need to feel better.
Oh, man.
I
I don't
there's
think we
nowhere to
want to
go
get
after
into
that.
that, right?
All right. Hey, listen. So we're going to continue the Q&A theme. Questions keep coming up. There's just some questions have a theme to them, and some questions have, one question kind of leads to another sometimes. Some questions we hear frequently enough. And so I think we may touch on some topics that we've kind of skirted around before. But when I was looking over some of the questions that came in to me regarding working with you, for example, there's a continuance of theme here. And so I think you and I've talked about one of these sessions. What we're going to do is we're going to kind of break it down and say, what is the process of buying a home?
Yeah.
Because you could say that there are basically 5 or 6 general steps, but that oversimplifies it. And the nuances are between the steps, of course, and the devil's in the details, everybody says. But if I have one more conversation where somebody says, George, I just don't know where I'm starting, I probably will hear that. I'm going to guess and say, so this is what, the first week of May.
Yep.
I'm going to guess and say in the remaining 6 months of the year, 6+ months of the year, minus the holiday period, I will hear that question asked at least once a week.
Yeah. And that, to be honest, I see that as a failing of our industry to have good, reliable education materials that go over, because it is a huge purchase. Most likely the biggest purchase, I'd say 90% of people will ever make.
More than
unless they're buying a business or, I think, this is probably 95, 98% of people. This is the biggest purchase they're going to make. And it's complicated. And there's a lot of steps to it. And it can go very smoothly. And you can kind of fumble through it sometimes and end up in a great position. But I just think the better educated somebody is, the better they'll feel. Like I said, you can fumble through and end up just fine.
Yeah.
But I think I hate when I'm talking to someone and you kind of get that, all right, do you understand? Yeah. I'm like, okay, you don't get it. I want to make sure that you get it because, I want you to feel good about what you're doing.
Yeah, there are too many stories you and I both have about, and it's our responsibility to help people through that process and educate them to it. But at the same time, for a lot of people, it feels overwhelming, and so they kind of put their hands up and they say, hey, that's too much. So hopefully these Q&A sessions will help break it down for people who have more, finite questions, but generally understand the process. But I do think we'll get into that process conversation. So on that Q&A note, I'm going to kick it off with a first question to you, because
Go for it.
this is probably more sensitive now because of what's changed over the past couple of years than it normally is, but it's still always a sensitive topic. And the question that came up to me the other day was, all right, George, what does it mean to have a lock in the rate, and when does that occur?
So the best way to start is to say that lock or rates are always either floating or locked. So floating means, I always like to say, picture that you're in your boat on the ocean. When the tide goes up, your boat goes up with the tide. When the tide goes down, your boat goes down with the tide. So as the market moves, as the ocean moves up and down, your boat goes with it. So if rates are going up and you're floating, you float up with the market. If they go down, you float down with the market. Once you lock in, you're taking your boat out of the ocean. Wherever you locked in at, that is what your rate is going to be. That's the day. And it's interesting because we do lock in rates, but more importantly, what we lock in is a point in time. So if you lock in, let's say, a 5% rate, and you decide a couple days down the line that you wanted to now pay a point to get your rate lower, we don't have to relock. We go back to that day and time and say, well, here's what it would have cost on that day to get your rate lower, and we can adjust your rate accordingly. Let's say that something comes up with appraisal and your down payment changes. Well, again, we go back to that day in time. We say, well, we're going to look at the day that you locked, and here's how your rate would have changed with that. Now, the day that you lock is the big question mark. You know, we do the best that we can as loan officers and everyone in the lending industry to forecast, but the forecasting right now of rates is all over the place. You know, this is not really a stable environment. At the beginning of the year, the biggest names in lending predicted that rates would be at around 3.75, maybe 4% by the end of the year. And we have we blew through that in the first month. You know, now we're five and up, 5.5 even. So predicting is kind of futile right now, but we do our best. So what we do is, you know, as you get in the process, as you actually go under contract, because you have to be under contract to lock your loan in, we just talk. You know, I'll call up and say, hey, George, today seems like kind of a good day. The rate would be this. What do you think? And you're going to say, well, what do you think about? And I'll tell you, you know, well, the Fed's meeting today, that can make things either go up or down. You know, there's a job openings number that comes out on Friday that can make the rate go up or down. And we just figure out if you're comfortable with the rate on that day.
So one of the things that, kind of playing off of that, one of the things that I'm not sure people, the logical question that comes in that is, well, how much could it go up? How much could it go down? Yeah. You know, how is it because then you get into the materiality of the difference. So for example, if you told me that my rate was going to be 5% today, but maybe it's going to go up, maybe it's going to go down a little bit over this week. And I say, well, by how much? And you say, well, it could be up or down by 1/8 of a point. So it could go up to 5.125 or down to 4.875. Okay. What does that mean mortgage wise?
Yep.
You know, what does that mean on the
very
payment?
Important conversation to have. And that always depends on the amount of your loan. But I always try to stress, you know, because I like to give options. So anytime I give someone a rate, there's the rate that you qualify for. That just means that your loan, your credit score, everything together makes you qualify for this rate. And you don't have to pay anything to get it. It's just that's your rate. But then there are rates that are lower that you can prepay interest. We call it prepaying interest, paying points. You can pay points to get this lower rate. So I always like to tell people, you know, like, all right, you're at 5%. If you went to 4.875%, the difference would be $20 a month. It would cost you right now, you know, $500. There's a chance that, you know, we're very close to hitting that. We could maybe get 4.875 tomorrow, you know, if we get another good day of rates. So that is an important discussion to have and talk about all the different ways it could go. Right now, once you're under contract, thankfully, we're seeing a little bit of stability. So the fluctuation should be minor. But for the people that are not locked into a contract yet, and they've been looking for 2 months, you know, the rates have gone up quite a bit in that time frame. All
right. Hey, real quick, just before we continue on, I only because your video seems to be lagging a lot, and I just don't know if it's just my system. Just
it might be me. Let me see.
So before we do the next question, if we have to restart it, we can. But
let me just cancel out a few things that I have open and see if maybe that'll help.
So while you're doing that, one of the things I'll touch on, because people, you know, like you made the example of it could adjust depending upon the size of the loan and everything, as you said, it could change it by even like call it $20 a month. Well, $500 right now is, some people may feel that's material or not. Okay. Mm-hmm. Everybody's financial circumstance is different. But if over the course of the first 2 years, I'm spending $500, I'm saving $500 difference, okay, in the first 2 years, then you take that into the following 2 years, that's another $500 difference. Now that's actually paid for itself in the second years. So that's where buying down the rate can be beneficial. And at the same time, 5 years in, the market rate may be such that they say, well, I'm going to refinance at this point in time anyhow. Yeah. So they may buy down up front, save themselves money over the next 4 or 5 years, and then at that time they refinance and they can save even a little bit more. So, but the bigger thing is that if they didn't change that, the life of the loan, the total savings over the life of the loan, because you look at that over the 30-year period,
yeah,
that's not an insignificant amount of money.
No, You're absolutely correct. So the math that we always do is you take whatever the cost would be for that buy down. Let's say it's $500 and you're saving 20. 500 divided by 20 gives us 25. That's the amount of months it would take for you to realize that upfront cost as a monthly benefit. It would take you 25 months or about 2 years to realize that gain. So we do the math like that very quick. And I always say, hey, listen, with rates going down, it's likely you're going to be refinancing in around the 2-year period. Is it really beneficial to pay this up front? Maybe not. Sometimes we do that math and it's 6 years out. And that's when I say, yeah, no, absolutely not. We're not paying points because most people are in a loan. Yeah, and most people are in a loan for 7 years. Honestly, that's the average. And I mean, in a loan, they're refinancing, they're moving, they're selling, they're doing a cash out refinance. Usually in 7 years, something happens in people's lives.
Yep. Okay.
That's really my turn.
Your turn. What do you got?
It's kind of a two-parter, but it's the same topic. First off, are foreclosures good homes to buy? And then secondly, George, I saw a pre-foreclosure on Zillow. When can we go schedule a showing?
Okay. Well, all right. You're right. It is kind of a two-parter. It is sort of tied in. But let me address the second half of that first. Perfect. Because that is probably, it's a really long answer. So I'm going to try and make it as brief as I can. But let's first start with, because a pre-foreclosure is actually something that you're knowledgeable about as well, of course, which is the fact that a pre-foreclosure occurs as a notice from a lender when a borrower has failed to make payments for a period of time. So usually after a certain number of payments, and every lender is a little bit different with how they handle that notice, but if a borrower has not made payments on their mortgage for, let's say, 3 months in a row, the borrower is going to issue notice to them saying, hey, look, you've got to correct this. If they continue to not do it, there's a notice that's put out because it now becomes public information about the fact that the person is not making their payments, which that public information gets picked up by somebody like Zillow. And then they say, oh, this person could be in pre-foreclosure, meaning there's the possibility that they're going to be unable to rectify things with the lender within a given period of time. And then the house may be reclaimed by the lender and then put on the market as a foreclosure property. That entire cycle, just the notice period alone can run for a couple of years. If the borrower and the lender are able to rectify, or they're able to put in a payment plan, or they just restructure the loan. But if the borrower can't do that, and after a period of time simply says, I can't do it, now the bank proceeds with foreclosure proceedings. But there's a whole process to that. Yeah. Connecticut is a strict judgment state. So in Connecticut, once the court determines that the foreclosure is moving forward to the benefit of the mortgage holder, the lender, there's no way for the borrower to rectify that. They're done. They have to leave. Okay. So meaning that after judgment's passed, they can't go back to the bank and say, hey, I found the money and I can pay it back, so I want to keep the house. Right. In some states, they allow that. They allow that even though judgment is passed, they can still resolve things with the lender. But the point is that I have seen foreclosure properties, meaning a house has now hit the market as foreclosed. You go back and look at the records, and the foreclosure notices went out 3 years beforehand. Oof. So when you see a pre-foreclosure reference on Zillow or anything else, it is not an indication that that property is for sale. In no way, shape, or form is it an indication that that property is for sale. That property simply has a notice against it. Now, once a property has been foreclosed upon, is a foreclosure a good property? Well, yeah, it is. For one simple reason, because it's going to be priced below its market value. But there's a reason why. Because typically there are issues associated with the house. So this is where it gets to, now it depends upon the loan type they're going to use. So for you, for example, if they're calling FHA, 99.999% of the time, a foreclosure home is not going to meet FHA requirements because there is going to be some level of defect on the house. The house sat empty. So when that person went into foreclosure process, most of those individuals are out of the house. Many just drop the keys on the counter, quite literally, walk out the door. Well, what's not happening? Heat's not on.
Yep.
Water's not being checked. Windows aren't being opened. Seasonal changes take place. You have mold growth now in the house. I mean, it happens all the time. I've walked into homes where we've had to walk in wearing full masks and everything because the extent of mold covered 2,000 square feet of a basement. Oh. You know, I mean, I got photos like you wouldn't believe. But anyway, the point is, So a foreclosure home can be a very good purchase if you are a buyer who has the capacity to renovate and rehab the house as needed. But a foreclosure house, if it's depending upon who it's being sold by, may prohibit inspections on the home because what if the pipes burst?
Yeah.
So there's a home not far from me, actually, went on the market about 6 weeks ago. The listing agent put photos on, priced it in a way that I got, I think, probably 40, 50 phone calls on it,
Jeez.
asking me if I could get them access to the house. And I had to call every one of them back and say, you're never going to get into that house. And they said, why? Look at it. It's only priced at this amount, which was like $150,000 below market value. And I said, well, there's a reason why. And they said, yeah, but the photos look great. I said, there's only 4 photos. And not one of the photos show the entire kitchen where all of the wood flooring has blown up through because the pipes burst, or the basement that had 4 feet of water in it and there's now mold growth. I went through the house.
Yeah.
So I saw all this and I told him, I said, you're never going to buy that home. That's going to go to an investor who's going to go in and they're going to renovate the house and put it back on the market, quote unquote, flipping. So if you are buying a foreclosure house, you have to anticipate that you're going to have issues. If a water, it'll be in the notes, house does not hold water pressure. That means somewhere in that house, there's more than one hole in that house in the piping. Well, when you turn on the water, you're going to find out where those holes are. Okay? Your plumber's going to go in and say, hey, I got to figure out where the holes are because it's not obvious. Maybe it's embedded in the wall. And so we got to start opening walls up. You got to see. So there's a whole thing there. But is it a good purchase? Absolutely, because you're buying something below market value that you can put improvements into and create forced depreciation. Absolutely. But you have to do it with a certain either A, loan type, or B, you got to do it with cash.
Yeah.
And if you do it with a loan type, and we won't get into it right now, but that's where you're going. Like if you're going FHA, you go to the 203K loan. If you're going conventional, you attach to it a rehab loan. But both of those, and if I misstate this in any way, but both of those are based upon the anticipated future value of the home. So what's called the after repair value.
Yep.
Okay. And how that ARV gets calculated, usually it's at 70% of market value is the lending amount, the loan to value ratio. Some will go as high as 80%. Some will go more, but depend, maybe they go loan to cost ratio, whatever. That's your department. But my point is, I absolutely encourage people to look at foreclosure homes if they have the capacity and the appetite to do the work needed and to deal with the headaches that are going to come from that, because it's not
a lot of headaches.
They have to assume 6 to 9 months is going to be the time it's going to take before they can move into that home. So do they have the capacity to stay where they are right now? Do they have the reserves to carry through the process? Do they have the time to manage the project, itself, the contractors, getting permits cleared, all that stuff?
Yeah.
But I think foreclosure homes are something that should be made more available for people who have the ability to do it. It doesn't mean that you have to be a high earner or anything like that. You just have to have, again, the capacity and the reserves to do it.
Yeah. Yep.
All right. I could go on for hours on that topic. I love that. Yeah, pre-foreclosure notices on the websites, you just got to ignore those houses. They're not for sale. All right. All right. We'll stick with the Zillow reference. I got one for you.
Okay.
Because this actually came up just recently. This gentleman I'm working with who's out of state, and he said, but George, when I looked on Zillow, it told me my mortgage amount and rate were going to be the following. Why is it not that?
Yeah, well, Zillow.
We're not beating up on Zillow.
I'm not going to say hides isn't the right word, but Zillow shows the result of their calculations. Remember in math class when you used to get your hand slapped for not showing your work? Zillow doesn't love to show their work. So they show a number and you have to click, on a drop down and look through how they got to that number. So they'll often show what I would call like a teaser rate, where maybe somebody somewhere out there is offering that, but it's costing a point and they don't disclose all that. They're just saying, well, yeah, you could get this rate somewhere.
So they're partly though, because don't they have a mortgage division?
Yeah, they're building that out. Yeah. I don't know if they use those rates or not. I haven't dug into too much of where they get their rates, but I know that if I Googled today, the lowest rate on a mortgage, I could find a rate that is great, but it's with a lot of conditions. Yeah, you have to have 35% down and you have to have a 780 score and you have to be in Texas and you have to pay 2 points, so they probably use some version of a teaser rate. They're going to always assume 20% down. which is a big difference for a lot of people. 20% down versus 3 to 3.5% down. They don't always assume the correct homeowners insurance rates. Some homes where I've assumed when I'm doing my calculations, something like $1,400-$1,500 a year, get it back from the the insurance agent, and they're like, yeah, it's $3,000. Okay, so now we have an extra $150 a month that we have to account for in our calculations. They don't always have the correct tax amount, even though the taxes are directly up the page, just a few boxes. They use an estimate based off of the area. They're not going to have mortgage insurance in there because they're assuming 20% down. So a lot of factors go into why that payment isn't the most accurate payment. It can be. Now it can be.
Wouldn't you
if you're
call
doing
it
all
the
those
best
things,
case scenario payment then?
Yeah, I would call that, definitely your very well qualified buyer scenario. What most people think of when they think of a home purchase, like that 20% down, which is just not realistic for, again, a huge portion of the population. I would say that's they're slotting it into that best case scenario purchase and just hoping that you just see the number, which you do. They put the number prominently on the page.
Yeah, and I mean, and again, we're not beating up on Zillow. It is a large. There's no denying the size of its audience. What it pulls in. You and I both have worked with clients that have come through Zillow many, many times. But if you go to whether it be Realtor.com, Redfin, Trulia, which is owned by Zillow, HomeSnap, or any of those that go out there, they all have some type of mortgage calculation, and so they all use basically the same principle, which is to show that best case scenario, if you will, or I should say, what is going to make this look more attractive to somebody. You don't want to show a high number. You want to show the best possible number. And but it's up to the consumer then to go through and, like you said, pull the drop down and say, well, I'm not going to be 20% down. I'm going to be 3.5% down going FHA. And my interest rate, I talked to Bill the other day, he said I'm somewhere more like around 5.5%. So I got to put that in there. And also that number is going to go like that, you know, and that's that. Yeah. I don't use the tools that are out there for that stuff. I always rely on, if I'm talking to you, for example, or some of the others, I always rely on what you guys, because you're looking at market rates every day. You have a better understanding of that. But you also take in, like you said, the totality of mortgage insurance or anything that may apply. Now, like you said, some buyers are not going to have that issue. They're going to come in and they're going to put 20% down, or, some people we know are putting 25 and 30% down because that's what they want to do. They have the capacity to do so. So fine. Then they're going to see something like that best case scenario.
Absolutely. Yeah. It's just at the end of the day, again, like you said, it's not a knock on them. They're marketers. It's just like when you see, a car commercial that says, payments as low as $100 a month. And then, the fine print there is $10,000 due at signing. Not a lot of people are throwing 10 grand down on their lease.
No,
their 2-year lease. So it's marketing. It's a tool though. Play with the numbers, try to make it a little bit more accurate.
Or just call your lender.
Just call up and say, and that's people, a lot of times I just tell them, listen, just shoot me an address. You can shoot me an address. I can send you a transaction summary in within an hour that has a breakdown of all the costs, what I'm assuming for title insurance, for closing costs, it's got all of it.
But if they use the apps, it's not necessarily wrong. They just have to make those corrections that are more applicable to their situation and what they're doing. Because then they're going to get at least a reference point. And then they can talk to you about the finer points to see just how much that moves. I got to assume that if they put in some of those adjustments, it's not going to be massively different.
No, it's going to be very close. Listen, at the end of the day, with what they're providing is a calculator, and they're a calculator, but not a psychic. So you have to mess with the inputs to get the correct result.
Right. All
right. Next up, I think this is a pretty good one for you. And it deals with a topic that I'm sure we could dive into a little bit more and can expand upon, but just from the eyes of a seller, why do they care if I'm asking for seller credits? Why does it matter to the seller?
Well, there's two answers there. The first is, does it dip into their proceeds or not? And the second is, does it convey something about the buyer that makes them question the buyer's capacity? So the first piece is, when when you have, so let's take a house and let's say it's priced at $250,000. Okay. And you're qualified for 260, so it's within your qualification range. It's not an issue. But your lender, working with Bill, for example, your lender has said, hey, listen, it's not that you need it, but boy, it would be good if you got some help at closing in the form of credits towards the prepaids and closing costs. Now, real quick clarification, seller credits are not cash to the buyer. In no way, shape, or form does any cross the table. What they're doing is they're taking from the proceeds at sale and applying those proceeds to pay down some of the debits on the buyer side. Okay. So, for example, you get your some of the taxes that are part of your prepaids. Okay. Your closing cost considerations there. So if a seller selling a house for $250,000 and you're qualified for $260,000, but Bill says, hey, listen, it'd be really good if you got $5,000 in credits. Okay. If you submit an offer for $250,000 and you say, and I want $5,000 in credit, the seller is now selling the house for $245,000 net to them, because that $250,000 minus the $5,000. So that's $245,000 net to them. So now the seller is going to look at any other offer they have and see, is somebody coming in where my net is going to be higher than that $245,000? And that's going to make them go towards that buyer. They may not choose that other buyer simply because it's different, because there may be other contingencies on that buyer's offer that make them hesitate more so. But that's fundamentally where they're going to start with. What is my net amount that I'm walking away with? And if it's less than what I want, then no, I don't want to give you those credits. So what a lot of agents will do is they'll say, listen, if you really need the credits and you want the credits, we can offer more on the list price. So you need $5,000 in credits. So why don't we offer $255,000? And it's a trade-off between the buyer and the seller. So the seller's not losing anything. They're getting their list price then, because the $5,000 comes off the top. The buyer's getting the assistance at the end of the day, but the buyer now is borrowing $255,000. So their mortgage amount is a little bit higher. They're basically paying their own closing costs fundamentally.
Yep.
So it helps the buyer get the contract accepted by the seller, because they're not hurting the seller, but the buyer is fundamentally paying their own closing costs through their mortgage, and they're paying now interest, of course, on that. But that may alleviate the need for cash at the upfront, which is, again, what you talked to them about. But the other side of it, though, is if you're a seller getting credits, getting offers where there's a request for credits, if sellers see, and what's it, 6% of the value of the loan is the maximum you can ask in credits?
For FHA, yes, it's on a scale. For conventional, it depends on how much you're putting down. It's either 3, 6, or all the way up to 9%.
Okay. So we'll keep it simple and just call it 6% across the board as the maximum amount. So let's say somebody's coming in on a $250,000 purchase, but they need the full 6% and they're going FHA. Well, what's that? $15,000, right? Yeah. So now you're putting in an offer for $265,000. Well, now the question becomes, hang on a second, can the house appraise at $265,000? Mm-hmm. So asking for those credits can go up too high, where a seller may look at that and go, I don't think the house can sell for $265,000. My listing agent doesn't think it'll appraise that high. So no, I don't want that offer after all. Even though it wouldn't be negative to them, I don't want that offer. There's one last piece to seller credits, because again, we could go on. We can unpack a lot here. But credits are not a guarantee. So when you put in the request for credits, if the appraisal value comes in lower than the purchase price amount, and the purchase price has credits built into it, the seller may come back and say, I'll agree to lower the price based upon the appraisal value, but I'm going to take the deduction also from the credit amounts I'm giving you. So now the buyer has to be prepared to put money back into the deal that they may have been getting from those credits. So let's use an example. I have a house listed at $250,000. I put in an offer of $255,000 because I need $5,000 in credits. The house appraises at $252,500, so I've lost $2,500 in credits. The seller says, I'll tell you what, that's fine. I'll sell for the $252,500, but I'm only giving you $2,500 in credits. So now the buyer has to put in.
Yep, $2,500. Yeah. So, and that can get scary quick if we were relying on those credits. So that can be the difference too. Is if we want them and it's just a smart use of funds, or if you are relying on it, then we can get in trouble quick.
There's another instance of credits that can come up, and sometimes credits can come after the contract in the form of to address items found during inspection. But that is a whole other topic. That is post the contract being accepted. So this is really about how, why would a seller take my contract? But we'll get into that credit conversation at a later date.
Yep.
All right. I got one for you.
Okay.
All right. Let's see here. What is the difference? How to put this? Aside from the obvious physical difference, what is the difference between buying a condo and buying a single family home?
Yeesh. Yeah,
Yeesh.
the loan type is, well, it's tough because condos, I think, get a stigma in the world of lending that isn't always due, because condos are, for a lot of people, perfect. George, you don't have to mow your lawn. George, you don't have to plow your driveway. You don't have to do your trees and shrubs. You don't have to worry about the roof. You don't have to worry about the siding. We'll take care of all of that. For a lot of people, that sounds perfect. I don't always love getting, my lawn done. I don't like going out and, trimming the shrubs and everything. So condos are great purchases, but they bring with them management associations, your homeowners associations. So now you're sharing walls with another unit. You're sharing costs with, multiple units. There's a lot that goes into this now that the lender has to step back and say, whoa, 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 whoa. So I was comfortable with you as the borrower, but now I also have to be comfortable with this whole association. I need a lot more paperwork. We have to get documents. We have to get insurance policies. Sometimes we have to get budgets. We have to see that the association's being run well. We have to see if there are any, what is it? Not dues. What is it when they're not the HOA fees, but one-time assessments?
Oh, assessment. Yeah. So like if a roof has to be done,
yes, yep,
they can extrapolate that over a period of time. That's their special assessment that gets paid either monthly or quarterly or annually and it's charged to each homeowner.
And it can be big. So, your HOA might be $250, but then there's a special assessment now for an extra $150. Well, we might have to take that into account depending on duration and where it's at and all that. So we have to look at these associations almost like they're another borrower. Like there's a lot of documentation that goes into it. So it can slow the process up. Now also the loan type can have an effect on how we view the association. So if you're doing an FHA loan or a VA loan, those have specific criteria that they look for. You can actually get FHA approved as a condo association, and then the process is a little bit easier for you. Or you're not approved, and we have to go through a spot approval process, which is getting one unit approved, which is a little bit more work. And then conventional actually just changed a lot of their standards as well. And the way that we look at that association is dependent on how much you're putting down. So, if you're putting 5% down, we might ask for, this stack of documents. And if you're putting 15% down, we might ask for this stack of documents. So there's just a little bit more work that goes into it. Again, they're great situations for a whole lot of people who just want to go to work. They want to come home, have time with friends and family. They don't want to think about the outside of the building. They don't want to think about mowing the lawn. They don't want to think about, oh, it's going to snow. Am I going to plow it out before I go to work? Do I have to do the sidewalk?
Well, but all right. So let me take the same question from a different perspective, though.
Yeah.
Because you're right. There can be. So one of the things you talked about paperwork. So condo resale packages get issued, and that usually contains a lot of what the buyer needs to present. For example, for you to say, okay, let me look over that resale package. You turn it.
I have my own documentation actually. So I have to order a condo questionnaire. So the resale is actually something for. So this is actually perfect.
The attorney side.
So George, same question entirely on you. What's the difference between purchasing a single family and a condo?
Okay, so to begin with, the process is the exact same in terms of how you buy. We don't change the process in any way, shape, or form. We still walk through that house. We still do inspections. We still get appraisals done. We still go to closing and have title. We still do all that. But there's a lot more that happens in between those posts, like you just described. A big part of it is getting the condo resale package, because if the condo resale package is not issued by the association, it means they're declining the sale and prohibiting it for a reason. Okay, so let me give an example. A lot of people go in looking to buy a condo because they think that they're going to own it and rent it. And they look at it as being an investment tool. A lot of associations are backing off because they don't want heavy investor ownership. They want owner occupancy ownership. So the first question is always going to be, is this association allowing investor purchases or owner occupant only? And they have a ratio that they keep. You know, an association can have 4 units in it. You know, I mean, it doesn't have to be a 400 unit thing. I just sold a condo recently. That association had 15 units in it. And their ratio for investor ownership had to be, I think it was 2 were allowed out of the 15. Wow. They were really cracking it down, and they were no longer FHA approved. So one of the things that came up, because we had offers coming in, there were a lot of FHA offers coming in, and I had to say to all of them, listen, I've spoken to the association, and you can attempt a spot approval, but we're not sure it's going to get met because spot approval comes down to ratio of number that are owned that have FHA with them. And there was only 1 in that association. Now it's only 15 buildings. So you don't have a ton of movement there for a potential spot approval. But backing up for a second. So the process is the exact same. We still do a showing. We still walk through it. We still do inspections. And like you said, roof and siding and things like that are the responsibility of the association. But doors and windows and the interior is the responsibility of the owner. So we still do an inspection to see, are there defects that need to be addressed through negotiation with the seller potentially. And the last thing is, of course, the title and appraisal still get run. But probably the biggest difference for buying a condo versus buying a home is, what are the stipulations of ownership? You know, what are the guidelines? Whether or not it can be owned by an investor? Is there a minimum period of occupancy before you can rent it out if you needed to? You know, what is the maintenance cost on it? Because some HOAs account for water, sewer, etc. Some do not. Some account for ground maintenance only. Some account for ground maintenance, trash removal. You know, they offer a bunch of things, you know, because it has a swimming pool, you know. It all depends upon the association. But I think one of the biggest things that I run into for buyers is they say, hey, George, I'm approved for $150,000 and I want to buy a condo. And I saw this one's $145,000. It's great. Yeah, but hang on a second. The HOA fee on that is $300 a month. That's going to lower your purchasing capability. So you can actually only look at condos that are priced, you know, more like $120. Because you need that leeway of that monthly payment or the quarterly payment of the HOA. But that's something they have to talk about with a lender such as yourself to find out, does that HOA punish their purchasing power down some? And a lot of buyers don't understand that. They just simply look at it because they say, well, it's priced at this amount. I'm approved for this amount, so that's what I want to go for. And so we usually start out the education with, let's make sure that the association meets the loan guidelines, if it's FHA, for example. Let's make sure we understand what the HOA fees are and what they account for. And then let's find out what the guidelines are for purchase, meaning if they only accept owner occupancy and they have a period of greater than 1 year, like some have multiple years before you can allow for rental. And I have a lot of buyers who look at a condo as a stepping stone towards that next purchase. And so they think, hey, after 2 years, I'm going to start renting it out because I'm going to go out and buy something else. Association may not permit that.
Yeah. Yeah. So it sounds like with a condo, you know, more so than with a single family, you do have to have that exit plan in mind just as much as the entrance. So if you're thinking, like you said, you know, like, yeah, well, I'm going to live here for a year and then I'm going to rent it out, and it's right there in the bylaws that, you know, you really have to have all of those points thought of heading into that purchase.
You know, one last thing about, I think it was fall of last year. So one of my buyers, he was looking for an investment property, right? So we specifically talked to the owner and we found out that the owner owned 15 units. So obviously there is an investor-friendly association there, okay? Spoke to the listing agent. Listing agent won't be an issue at all. The guidelines allow for it. Yes, that's pretty much everybody walking through this is looking for an investment purchase. Got it, no problem. I think of the 15 units that this person sold, they lived in one and they were renting out the other 14. I think 9 of them were declined for sale, including the one that my client offered on. The association said no. They were buying them back from the owner because they wanted the right to either rent them out or sell them at a higher value later on. So they prohibited the owner from selling those.
Wow. I honestly didn't even know that they could do that.
A board can decline a sale.
Wow. Okay.
The board can decline a sale. That's why the condo resale package is so important, because until that is issued, you do not have a purchase, because the board. So I've had some cases where boards have the condo resale package was ordered too late, or it took too long to arrive, and it showed up 3 days before, and then there were stipulations in the resale package that affected the purchase. That's why the first thing we do is, when we know we're going under contract, we request the resale package be ordered. Most owners won't order the resale package till they know they've cleared inspection, because they want to know that the buyer is going to continue on. But yeah, that resale package that's the key.
Yeah.
Because everything that you described is in limbo until we know that the resale package is in hand, because then we know that the board has approved the sale.
Yeah. Yeah.
And it's the same thing with co-ops. Okay. So I have a buyer right now working through a co-op purchase. All the application, everything's been put in. You're not going in and bidding on this property, because it has almost a fixed value as a co-op, right? But the board has to sign off, and the board's going to look at the qualifications of the buyer. So they act like the lender first before a lender gets involved.
Wow.
Yeah.
Yeah. A few more hoops.
It's a little bit more complicated.
Nope.
All right, I got one for you.
All right.
Because you touched on it earlier. And you touched on it when we were talking about the mortgage rate calculation, or the mortgage calculation and the rate calculation. And you mentioned mortgage insurance. I think people generally understand mortgage insurance as a concept, but I don't think they understand what it actually means, what it costs, and why it's needed.
Yeah. So mortgage insurance is essentially it's insurance against loss for the lender. So with the size of the loans that we're giving out, risk of default of somebody not paying can be extremely costly. So if we're talking about foreclosures, if somebody doesn't pay, and let's say they bought the home for $100,000, they put $3,000 down, so they made a couple payments. Now the balance that they owe is $95,000. And the home is, like we said, worth $100,000, the lender is going to have costs associated with going through the foreclosure process. And there's going to be months or years of attorney fees and trying to get it back onto the market. We could end up selling that thing. Like you said, most foreclosures are sold below market. You could take that thing could sell for $80,000 on top of all the other fees that the lender could be taking a $20,000-$30,000 loss on that property at the end of the day. So mortgage insurance is an insurance that protects the lender against that type of loss, that type of default. So you'll see this need depending on the type of loan that you're getting. A conventional loan, because conventional loans are not government backed, they're essentially private loans. You're going to have private mortgage insurance, PMI. So if you put 20% down, though, there's a big enough gap there that the lender says, you know what, we're comfortable that even if you stop paying and it went into foreclosure and we had to incur those fees, we can probably still sell it and at least break even. So you don't need private mortgage insurance. But if you're putting 3% down, 5, 10, 15, all the way up to 20%. So if you're putting 19.9% down, you're still going to need some measure of mortgage insurance. Now, obviously, it gets less and less the more you're putting down, because our risk gets lower along the way. But you still have to have it. Now, it's a monthly payment. It's a monthly amount based off of the unpaid balance for the conventional loans. And it just, so your mortgage insurance goes down as you pay down your loan. And then once you get to 20% equity in your property, you can say, hey, I'd like an appraiser to come out and just cancel appraise it real quick, cancel the loan mortgage insurance for me. And then it automatically has to go away at 22% equity for you. So that happens automatically on the lender side, but you can request it when you get what you think is 20% equity. That's just conventional. FHA has an upfront mortgage insurance. FHA doesn't care how much you're putting down. They are still going to require mortgage insurance. If you put 10% down, then FHA mortgage insurance can go away after 11 years. If you put less than 10% down, which most people are doing FHA loans, they're doing that 3.5% down. You're going to have mortgage insurance for the life of the loan. Again, it goes down every month every year because it's based off of that unpaid principal balance, but you'll have it for the life of the loan. So a lot of people end up trying to refinance out of, mortgage insurance. Now, the other thing that I'll note as well is FHA mortgage insurance is set. Doesn't matter what your credit score is. For a lot of people, that is beautiful. And we love that because they might have a lower credit score and it doesn't matter, not punished for it. For conventional loans, your mortgage insurance is based in part on your debt to income ratio and your credit score. So people with lower credit scores that are trying to make a conventional loan work by the numbers, they still technically qualify for this conventional loan. Sometimes the mortgage insurance rates for them are punishing. It can be twice as much as what an FHA mortgage insurance would be. And that's when I'll say, well, hey, listen, even though you might technically qualify for this, the monthly payment is way more. We should look for FHA for the time being.
When I bought this house, we had PMI in the beginning, and it's partly because at the time, my personal credit, my wife's credit was phenomenal. My personal credit was not as good. So I weakened our purchase because of that. And we had to get PMI, and also just because of what we're putting out. But it's funny because everything you just described, when I bought this house in 99, none of that stuff got discussed. None of it. I mean,
some of it has changed, but
I mean, the industry is just so fundamentally. I mean, it's not even fundamental. It's so vastly different from what it was from 20 plus years ago.
Yep.
It amazes me because at the same time, if I think back to 2006, 7, and 8, when all the nightmare occurred, and what occurred then, I'm thinking about my neighbor's house and what he paid at that time. He had, I could go on and on, but I'll be careful. But he had his principal, he had an adjustable rate. When the market tanked, he was paying, I think he told me he was paying nearly 27% interest. Because
you can't even survive.
He was at the point where he couldn't refinance it because there was no refinance option for him in the market. I mean, they made it through. I give him a ton of credit because they made it through it, and they went through a lot of headaches. They went through, the pre-foreclosure notices and all that stuff happened to them. But they held on. They're still here. God bless them. He's made it through. But yeah, I mean, the highest we ever paid, because our combined interest rate when we purchased was about 13.5%. The highest we paid at one point in time was almost 18%.
Yeah.
Today, we talked today about 5% and everybody's freaking out. And I'm kind of going, yeah, everything's relative, guys, because I got news for you. Yeah, my house costs less than what you're paying today, but I was paying a whole lot more in interest rates. Yeah. So trust me, I felt that pain.
I saw some stat that said that homeownership today is actually cheaper than it was 20 years ago on a relative basis.
I was going to say, everything is relative.
Yeah.
But yeah, that doesn't surprise me. All right, I got time for one more. You got any more?
I do. I have a good one for you that you can probably riff on a little bit. It kind of ties into some of these other ones, but I want to see where you go with it because I think that you probably encounter this a good amount. I found a real cheap property. The listing says
not right now. You didn't.
The listing says cash buyers only.
Oh yeah.
Can we go look at it? What do we have to think about?
Well, okay. So I made the joke about, not in this market, but there are properties that are marked that are being sold at what feels like an under market value. So the first question is going to be, is it a foreclosure home? Yep. So that's going to be the first question. Because if something says it's cash only, the immediate trigger there is that it will not meet safety or health hazard conditions as required by a loan, FHA, conventional, otherwise. There may be, so for example, let's say the stairs are coming away from the house. And so there's no safe access to the home. So it has to be a cash only purchase. And in those cases, then there's no appraisal, obviously, because you're no loan, but you're probably also not getting anything done through inspections. And the seller is unlikely to negotiate anything coming out of that. So those purchases, when you see them, so that's the example I gave a few minutes ago where, the floors had all popped because of the water damage. Okay. That had to be effectively a cash only purchase because there was just so much deterioration to the home. Nobody was getting a what I'll call a standard loan for that. You have options in terms of loan types. You can do hard money loans. You can go through private lenders. You can do those things. That's a totally other topic. But to answer part of the question that you asked, which is, can I go look at it? Sorry, my phone is just blowing up. Can I go look at it? The short answer is sure. We can always go look at it. But if you're not capable of buying it, are we just window shopping? Because if so, then we all got better use of our time. But if you're looking at it and saying, no, wait, I think I can make this happen because I want to pursue this, and this gets into the whole conversation I had the other day about going in with a cash offer, then flipping over to a loan. That's not going to apply. But as long as everybody understands up front that you're looking at a house that is so distressed that the reason they're saying cash only is because there are conditions on that house that the listing agent knows will not meet loan criteria.
Yeah.
That said, there are some sellers who also say, I don't want to deal with an appraisal in any way, shape, or form, so only want buyers coming in who are cash.
Yeah.
Doesn't mean that the house is falling down. It just means that the seller is looking at it saying, I don't want to deal with any of that stuff. I'm willing to sell the house at a different price in order to bring in a cash buyer, but I am not dealing with appraisals because I know that that's not something that this house is going to qualify for, and it's not worth it. At the same time, I don't want to listen to a buyer coming in wanting to negotiate things they find at inspection. And that kind of gets more into the as-is sale reference, which is a totally other topic. But if a house is priced what feels like it's below market, there's a reason why. If you want to put in a cash offer because that's what they're saying, it can only be that, and there's a difference in process for it. Obviously, you're not involved, for example, and you have to be prepared that it usually means that there is zero negotiation coming out of any inspection, and inspections may be required to be for information purposes only. And some listing agents will put that in there: inspection for information purposes only. Because what they're telling everybody up front is, do not come in after you've had your offer submitted, and if it's accepted, do not come in looking to negotiate terms on the house. If you find something that you don't like about the house because you chose to do an inspection anyway, now let's say you chose to do an inspection and you did a sewer scope, and because you said you had questions about the plumbing, so you said, let me do a sewer scope because I see a lot of trees out there, and the house hasn't been lived in for 3 years, and so now I'm wondering about root growth around the sewer. So part of the inspection process, we call up a plumber. Plumber comes out, does a camera down it, and says, hey, look, you got a lot of root growth there. We need to get a cutter in there. Oh, but wait, I see that the pipe is starting to collapse. Okay. You as the buyer, even though you came in with a cash offer, you have the right to walk away and cancel because you still did an inspection. You have that contingency still in your contract. You have the right to cancel because you've decided that the term of the house, the condition of the house, and the repair it needed exceeds what you're willing to spend. And since the seller has said, hey, we're not going to negotiate anything, fine, then I'm just not going to buy the house. You cancel contract, get your deposit back, and you walk away because you did it under the inspection contingency. Now, I have some buyers who will go in on cash-only purchases, and they will waive doing any inspection. So now they've removed any contingency ability to walk away if they found something. And I've had one buyer who did this. He learned a very difficult lesson. And I told him, I said, you don't do this. Because at the end of the day, you're gonna find yourself in with a bit of a headache here. And sure enough, he went through. He said, "Don't worry about it. I got it covered. I can deal with it. No, I'm not worried about it." Well, there was nothing really wrong with the house, but his situation changed.
Oh,
and so there was really no reason for the inspection not to. The inspection wasn't going to reveal anything that was so substantively bad that he would have said, "I can't buy it," because we did a walkthrough. We saw everything. But his situation changed where he did not have the cash available at that time anymore to make the purchase. So he had to walk away because he had no contingencies built in. He lost his deposit.
Oh, that is an expensive lesson.
Yeah. I mean, he was too aggressive with it. He waived everything, eliminated everything. I kept telling him, don't do that. But he did it anyway because he wanted to get the deal. He got the deal because he made the offer so attractive. The seller said, great, there's no risk to me here.
Yeah.
And I think a week later, we had to issue a termination. And, the attorney turned around and said, we're going to try. I think it was a little bit of a back and forth over a few weeks, but ultimately they could not get the parties to agree. I don't know if he lost his full deposit, but I know he lost. Because the seller said, hey, look, I took the property off the market in good faith. You had the intent to purchase. You had no contingencies on it. So why should I? You're in default.
Exactly. Quick money for them.
All right, my phone's blowing up, so unfortunately I got to run. As always, it's good to chat with you. I appreciate the time, appreciate the Q&A. I think we probably in this conversation touched on a few things that we'll probably expand upon in a future one, but we'll get it going again.
Yeah, I look forward to doing the market, and then now we can wrap that right in with what happened with the Fed.
Cool.
So hopefully later this week we'll get to touch on that.
Sounds good, man. Hey, listen,
All right.
you have a great day. I'll catch you later. Thank you again, as always.
Yep. Take care, George.